Hello, my name is Monica Loeffler. I'm Head of Direct Finance at Charter Hall, and I'm here today to provide an overview of tax-deferred income. I'll discuss what tax-deferred income is, the benefits to investors, and where investors can find details of the deferred income tax components of their investments. Please bear in mind that this is not intended to be tax advice, and your tax outcomes may depend on your individual circumstances. Charter Hall direct funds pay income to investors in the form of distributions, either on a monthly or quarterly basis, and are treated as flow-through trusts for income tax purposes. This means the investor pays tax on their share of the income distributed, rather than the trust paying tax directly to the ATO. The components of income retain their character when distributed from the trust to investors. For example, rental income earned and capital gains triggered by the trust are treated as rental income and capital gains by the investor. Tax-deferred income arises when a fund's cash distributable income is higher than its net taxable income and is mainly due to timing differences and non-cash allowable deductions, such as depreciation. The tax-deferred component of the distribution is not assessed as taxable income at the investor's marginal tax rate when it is paid to the investor. Instead, the tax-deferred amount is applied as a reduction to the tax cost base of the investment, which is used to calculate any capital gains tax liability at the time of sale or redemption. Therefore, it may be deferred until the sale or redemption of the investor's units in the fund. If the accumulated tax-deferred income reduces the investor's cost base to nil, any additional tax-deferred distributions received are assessable as capital gains to the investor at the investor's marginal tax rate in the year of receipt. Now that you have a brief understanding of what tax-deferred income is, I'll provide insights on the benefits of tax-deferred income for investors. Please remember, these benefits are dependent on the individual circumstances of investors. As the tax-deferred component of the distribution is not taxed in the year of receipt, the investor receives greater after-tax cash flow during the investment term. This can be reinvested in other investment opportunities, and the compounding benefit from reinvesting this additional income can be significant. In addition, tax-deferred income is only assessed when an investment is sold, as long as the total tax-deferred income does not exceed the investor's cost base in the investment. Therefore, this is taxed as capital rather than income. Depending on the investor's marginal tax rate and length of time the investment is held, it may reduce the amount of tax that otherwise would have been paid if it was taxed as income in the year of receipt. Charter Hall sends annual tax statements to investors in August of each year. The annual tax statement will advise the amount of cash distributed and will set out the components of income distributed to investors, including the amount deferred. In summary, investments that provide the ability to defer tax income can provide significant benefits to the investor by deferring the payment of tax until the investment is sold. In addition, depending on the investor's circumstances and length of time the investment is held, the amount of tax paid may be discounted. Thank you for joining me for our bite-sized learning on tax-deferred income and some of the benefits for investors.